Worried about bank stocks sliding this year? Here's why Goldman Sachs and Wells Fargo may hold up better than the pack, and what that means for your portfolio. Bank shares are under pressure as the economy cools and interest rate expectations shift. Investors are rethinking earnings power, and the sector faces a tougher setup than in recent years. Three forces are doing the damage: higher funding costs as deposits reprice, credit losses moving back toward normal, and stricter capital and liquidity rules that limit flexibility. This backdrop squeezes net interest margins, so banks that rely mostly on spread income feel it most. The gap between what banks pay on deposits and earn on loans is narrower than in past cycles. That puts a premium on fee income, trading, and cost control. It also makes regulatory capital more than a compliance box. It's a binding constraint on payouts and balance sheet strategy. Minimum CET1 stands at 4.5%, with buffers pushing typical targets closer to the high single digits, and G-SIB surcharges add another layer for the biggest firms. Here's where business mix matters. Goldman Sachs leans on investment banking, trading, and wealth and asset management. Those engines tie to deal activity, market volatility, and client flows, drivers that don't move in lockstep with retail deposit costs. As funding gets pricier across the industry, Goldman's diversification can cushion margins and smooth earnings compared with lenders that depend heavily on net interest income. Wells Fargo looks different, but the logic is similar. Its large consumer and commercial banking franchise provides scale in deposits and payments, which helps on costs. The Fed's asset cap at $1.95 trillion limits balance sheet growth, but it has pushed the bank to simplify operations, strengthen risk controls, and emphasize profitable relationships over raw expansion. That focus can sustain returns even as credit losses normalize. For investors in single bank stocks or financial sector ETFs, the takeaway is straightforward. In a tougher rate and regulatory regime, business models with meaningful fee income, trading capacity, or scale advantages are better positioned. Assess each bank's sensitivity to deposit costs, its reliance on net interest income, and its capital buffers. Earnings quality and diversification matter more now than chasing the highest yield. Want deeper analysis and the full breakdown? Read the full article at finlitica.com. Quick reminder: this is general information, not financial advice. Your money, your decisions, so always do your own research.